Okay, let's talk investing. It often feels like this intimidating world, doesn't it? Like it's just for the Wall Street pros. But what if that wasn't true? What if everyday people could actually succeed just by being, well, disciplined and observant? Sounds pretty good, right, Ton? Today, we're diving deep into the thinking of Peter Lynch. He's a legend in investing, truly.
Absolutely.
A giant.
And this isn't just history. His ideas offer a real blueprint for you. As manager of the Fidelity Magellan Fund, this is back in 77 to 90, he pulled off an average annual return of almost 29%. 29.
It's staggering. Made it the best performing fund in the world during that time.
Yeah.
Just incredible.
And the best part, he didn't keep it all secret. He laid out his philosophy, his strategies, loads of real examples in his book, Beating the Street.
Yeah. And that's our map for today.
Exactly, our treasure map.
You know, what's really fascinating about Lynch, beyond just the numbers, is his core belief. He really championed the everyday investor. He kind of reminds us that just knowing stuff isn't enough. It's about understanding it, applying it, you know, making it work for you. So our mission here is to pull out those key nuggets from Beating the Street. Practical, common sense strategies, stuff that cuts through all the noise.
Right, the jargon.
Exactly. And a really important question we want to explore is, well, how can you use what you already know, your day-to-day experiences, to get a real financial edge?
That's such a powerful idea because honestly, so many of us think, oh, investing, that's too complicated. Needs special data, inside info.
Yeah, that's the common trap.
But Lynch just flips that completely. He says ordinary investors can actually, well, beat the professionals. How does that even work? What's the logic there?
It really boils down to one key advantage: being closer to the ground. Think about it. Wall Street analysts, they're often deep in spreadsheets, right? Data rooms. But individual investors, we're out there living. We're buying things, using services, seeing what's popular, what's actually working.
Okay.
So you often spot trends, maybe months, sometimes even years, before they show up on the big institutional radar.
Ah, so like seeing the queues outside a new shop or everyone suddenly using a particular app.
Exactly. Who spots that first? It's usually us, the consumers, not necessarily the analyst buried in numbers.
That's a really interesting distinction.
Yeah.
So, okay, our everyday observations are kind of like our secret weapon.
Right.
But how do we go from just noticing something
Hmm.
to making it, actionable, something that actually guides where we put our money?
Well, that leads straight into Lynch's most famous idea: invest in what you know.
Yeah.
He's basically challenging you, challenging all of us, to turn our daily lives into, like, a personal research lab.
Ah, a research lab.
Yeah. What businesses, what products, what services do you see all the time? What are you using? What are people genuinely excited about? He wasn't hunting for obscure tech breakthroughs only an expert could grasp. He looked for stuff that was visible, successful, right there in front of everyone.
So it's not just about what I personally like, but maybe what I see flying off the shelves or what my friends can't stop talking about.
Yeah.
Like if I see a certain type of, say, vegan cheese suddenly in every supermarket deli counter when it wasn't there 6 months ago.
Yeah.
Is that the vibe?
Precisely. That's exactly it. Lynch himself talked about how noticing his wife loved Eleg's pantyhose.
Right. I remember that story.
Or seeing the lines at Dunkin' Donuts, those observations led to some of his best investments. He saw real, tangible signs of strong businesses. Today, maybe that's noticing a niche coffee brand that's suddenly everywhere, or, I don't know, a specific pet food brand that all your neighbors are buying.
Right.
Your edge is often that early spotting, way before it's headline news. So what are you seeing people really embrace? What's got buzz? Loyalty. That's your starting point.
That definitely reframes how I look at, well, just going to the shops or talking to friends. It makes consumption feel like potential research.
Okay, but say you spot one, a company you know from daily life. They're not all the same, obviously. How do we move from, hey, that product's popular, to understanding what kind of investment it actually is?
Right. Good question. Because identifying the company is step one. Step two, and this is crucial, is classification. Lynch famously broke stocks down into 6 categories. And this isn't just like academic sorting. For you, the informed investor, it's vital because each category needs a different approach, different expectations for growth, risk, timing.
Ah, so no one-size-fits-all strategy.
Definitely not. That often leads to disappointment. You need to know what you're dealing with.
Okay, 6 categories. Let's walk through them. And maybe focus on what each one means for strategy for someone who gets the basics. Sure. First up, slow growers. Think mature, big companies. Growth is modest, but usually steady. Utilities are a classic example, some consumer staples maybe. Strategy-wise, you're not really looking for rapid price jumps here. It's more about stability, maybe dividends, sort of a bedrock for the portfolio.
Got it. Foundational. What's next?
Then you've got stalwarts. These are also large, established companies, but they have a solid track record of consistent earnings growth. Think like 10, 12% a year. Coca-Cola is the textbook example. They're pretty reliable, often handle downturns better.
Okay.
So for investors, stalwarts offer a nice balance, right? Growth plus relative safety. They can be anchors, compounding steadily over time.
Makes sense. More growth than the slow growers, still pretty dependable. Okay, what about the really fast movers?
Right, that's category 3, fast growers. These are usually smaller companies, expanding rapidly, maybe 20-25% growth a year, or even more, often in new industries or they're shaking up old ones. This is where you find the highest potential returns.
But also the highest risk, I bet.
Exactly, higher risk. The challenge is finding them early, understanding why they're growing, and knowing when that growth might start to slow down. It's hunting for the next big thing before the crowd.
Okay, slow, steady, fast. What about companies tied more to the economy's ups and downs?
Yep, that brings us to cyclicals. Their fortunes rise and fall with the broader economic cycle. Think airlines, auto manufacturers, steel, maybe even some retail. They boom when the economy's good, struggle in recessions.
So timing is everything there.
Absolutely critical. The classic advice is buy them when things look bleakest for the industry and sell when everything seems rosy. Takes guts and a good read on the economy.
Yeah, buying low like that takes nerve.
Okay.
Okay, 2 left. What about companies that are already struggling but might bounce back?
Those are the turnarounds. These are companies in trouble, maybe even near bankruptcy, but there's a belief they can recover. Could be new management, smart restructuring, maybe the market shifts back in their favor.
Risky bet, though.
Definitely higher risk. You need to do deep homework here. Is the recovery plan credible? Is it actually happening? But if they pull it off, the rewards can be huge. It's like finding that hidden gem, but you got to sift through a lot of rough.
The ultimate fixer-upper investment. Okay, and the last one.
Last one is asset plays. These are companies where the stock price just doesn't reflect the true value of what they own. Maybe it's hitting real estate value, valuable patents, a subsidiary the market missed, or just a pile of cash on the books.
So like a hidden treasure hunt on the balance sheet.
Kind of. It often takes some digging into the financials to spot these undervalued assets. You're basically bargain hunting. And, if we zoom out, understanding these 6 categories really helps you tailor your strategy. You wouldn't judge a utility the same way you judge a tech startup, right?
Right. Different game, different rules.
Exactly. Each needs a different lens.
That makes a lot of sense. Moving beyond just liking the product to understanding the business itself. Okay, so we've spotted a company, we've maybe categorized it. But that's still not the whole story, is it?
Right.
How do we really know if it's a good investment? What's the homework involved? Is it just getting lost in numbers?
Lynch would definitely say that observation is just the start. The real work is do your homework. No shortcuts. It means digging into the company's fundamentals. You need to understand its financial health, its actual potential. For someone like you who follows this stuff, it's not about memorizing financials, but getting the key signals. Is it profitable? Are earnings growing? Is the balance sheet healthy and more assets than debt?
Right. And did he favor specific numbers or tools for that homework?
Yeah, he kept it pretty practical. He looked at standard stuff like the price-earnings ratio, the PE, just the stock price divided by earnings per share. Gives you a quick sense of market expectation. Is it expensive? Cheap? Why? He'd also look hard at growth rates, naturally, and dividend yields if income was part of the goal. But the main point was clarity. If you can't quickly grasp the business's health from a few key numbers, you probably don't understand it well enough.
Okay, that sounds like solid work. But then Lynch also famously said, don't overcomplicate investing. How do those fit together? Do the homework, but keep it simple? Feels a bit like a contradiction.
It does, but it's a really important nuance. Don't overcomplicate isn't code for being lazy. It means focus your homework on what really drives the business. Avoid getting sucked into super complex financial instruments you don't get, or chasing the latest hot tip without understanding why it's hot. He was basically saying, stick to businesses you can understand. If you can't explain why you own a stock, simply maybe to a teenager, or just clearly to yourself, then it's probably too complicated for you.
So focus on understandable businesses, even if they seem a bit, boring. And it sounds like he's telling us maybe boring is beautiful in investing.
He absolutely believed that. A quote-unquote boring company with steady, predictable earnings often beats the flashy, speculative stuff over the long haul. Think about, I don't know, a well-run waste management firm or a solid regional bank. Maybe not exciting dinner party talk,
Ah, probably not.
but their consistent earnings, their market position, maybe overlooked growth, that can be incredibly powerful over time. Less drama often means steadier returns. It's about solid businesses, not just exciting narratives.
That's such a crucial point against all the hype we see about getting rich quick.
Yeah.
Lots of people want those fast wins. But what did Lynch say about trying to time the market? Was he into that high-speed trading game?
No, quite the opposite. He was very clear. You need a long-term mindset. He strongly advised against trying to time the market, predicting the daily or weekly zigs and zags. He saw it as basically a losing game for most people.
A fool's errand, yeah.
Pretty much. His approach was find good companies through your research, buy them, and then hold them long enough for their value to actually play out. It's about building wealth steadily, not overnight. Patience and conviction are key.
Patience is one thing on paper, but it's tough when the market's going wild, or you see everyone else piling into some crazy stock. How did he suggest people handle that emotional roller coaster?
He had a fantastic quote for that. The key to making money in stocks is not to get scared out of them. Simple, but powerful. He knew fear and greed are huge obstacles for investors, so he stressed patience, discipline, sticking to your plan, market drops. If you've done your homework and still believe in the company, that's often a chance to buy more at a better price, not a signal to panic sell. It takes conviction based on that homework.
That definitely requires mental strength. Because even with all the research and patience, mistakes happen, right? Lynch himself couldn't have gotten every single pick right. How did he view making mistakes?
You're absolutely right. He was very open about it. Mistakes are just part of investing. You can't avoid them entirely. The key, he said, isn't never being wrong. It's learning from those losses, figuring out what went wrong, and making sure your winners more than make up for the losers over time.
Okay.
He also really emphasized diversification, not owning hundreds of stocks you can't track, but spreading investments across different sectors and those 6 stock categories we talked about. That helps balance risk, so one bad pick doesn't sink your whole portfolio, which, raises a good question for you listening.
Yeah.
How do you build that kind of resilience into your own approach, knowing mistakes will happen?
And in the book, Beating the Street, he really opens up about his time at Magellan, doesn't he? It's not just theory.
He does, and it's incredibly valuable. He gives you this transparent, behind-the-scenes look at how he actually ran one of the world's biggest funds. And crucially, he shows it wasn't magic or secrets. It was the consistent application of these common sense ideas we've been talking about. He explains why he bought certain stocks in plain English. It shows successful investing is about logic, patience, discipline, things anyone can cultivate. It's really empowering.
Okay, so let's quickly recap Lynch's core ideas for you. First, use your everyday observations. See the world around you as a source of investment ideas. Second, do your homework, but focus on businesses you can actually understand.
Right. Keep it understandable.
Third, know what kind of company you're buying using his 6 categories. That sets your expectations. And finally, play the long game. Be patient, disciplined, don't get scared out by market noise, and use diversification. Beating the Street really aims to empower you, the individual investor, with confidence built on common sense.
Yeah, exactly. And if we connect all this to the bigger picture, Lynch's philosophy, it's not just about stocks, is it? It's really about thinking critically, being curious, paying attention to the world. So maybe here's a final thought for you to chew on. Beyond the obvious success stories, what overlooked asset plays might be hiding in plain sight? Maybe in your local community, your daily commute, businesses you interact with. What's out there just waiting for a curious, Lynch-like eye to spot its real hidden value?